Hey gang, welcome back. This is Investing 101, your financial class. This is class 7 of a series. So check out the playlist to find the classes that preceded this. If you haven't seen them yet, it's a good idea to go back and watch them. And there will be more videos coming in the future. So again, that playlist is your answer. And if you hit the subscribe button on the channel and possibly the bell on it, you'll be notified when the new videos come out so you can watch them. This is free financial information shared from one friend to another. And today we're going to be covering insecure securities and the spreadsheet that I've alluded to several times before, which is probably the most exciting part for me about this course. The most unique value that you'll find in this course against all the other financial classes is this spreadsheet that I've built, and I've never seen anybody else have anything like it, and I'm going to share it with you. So let's get started. Insecure securities. So there's a bunch of insecure securities, but a couple of them that I want to call out because it's a pretty simple classification to draw. There's penny stocks and there's cryptocurrencies. Now, penny stocks, in my layman's definition, are stocks that trade for less than $1. Like literally, you might be able to buy a share for a few pennies. And my little story to tell is I got several years ago, many years ago, I got a letter in the mail that talked about this unique and rare opportunity, this stock that was sure to skyrocket very soon, and you can get in on the ground floor. And it was just several pennies per share or whatever. I don't remember exactly what it was, but it was super dirt cheap. So I threw probably $25 at it. I don't know, and probably got 100 shares for my trouble. And the stock promptly went to zero. So I lost my 25 bucks. So as I've said in previous classes, investing in individual stocks is an inherently higher risk activity. Mutual funds, ETFs, other things that are well researched, but they give you some measure of diversification built in, whereas a stock is anything but diversified. So it's already an inherently risky activity, but buying stocks that are have low trading volume, low market cap, or just super low price are red flags. Not to say that they're bad picks necessarily, but you should be extremely cautious and really know what you're getting into. And by all means, don't take the word of the person that's trying to get you to buy it. Like, get some additional advice on it. I only had to make that mistake once. And so as far as the penny stocks go. Now, cryptocurrencies, I'm actually really bullish on cryptocurrencies in general. I really like them. I hope that they are the future, but they are insecure. They're highly volatile assets. There's thousands of them. Most of what it's a dot-com bubble all over again. A few will rise and most will die. So diversification when it comes to cryptocurrencies, and certainly doing a lot of research and keeping tabs on the news and things, is super critical. So I'm not saying don't invest in them, but I would say they should make up less than 20% of your overall portfolio, and even that might be too high for some people, or maybe most people. So be very cautious with cryptocurrencies. But write to your senators and try to get them to pass laws to make them more actually practically usable as a currency, because right now the tax laws make them fairly prohibitive. And they're actually considering some laws that will allow them to be actually used as currencies a bit more than they are today, which would be great. But next class is going to focus on stock options, and the class after that will be on cryptocurrencies specifically. So be sure to come back for that if this area interests you. So now we're going to talk about the spreadsheet. Super exciting stuff. All right, let's start by what you'll see when you download it. So the link to the spreadsheet will be in the description of the video. And I encourage you to go and download it now and get to this point so you can walk through the spreadsheet while I talk about it. When you download it, you'll get an XLTX file. This is an Excel template. So when you open it, it will create a new document every time. So you'll open it, and when you save it, you'll have to give it a name, and that's what you should use from now on. And you should probably delete the template to avoid confusion, because the template won't have your data in it. It'll be the new document that you save. So when you open it, this is what it looks like. Notice the title is Investment Savings Starter 1. So if you click Save, it's going to ask you where to save it, and you can go ahead and do that. It's a good idea. I generally recommend saving documents before you start working on them so that you know where to find them later. It'll take you to this worksheet. We're going to skip this and go to payments for now. We'll come back to parameters later. This worksheet is where you really make it yours, and you get to put in your own reality, your own projections, and the better data that you put in here, the better the worksheet will predict your future, including all the way up to retirement and through retirement. So let's start with, as an assumption, that you can put in $50 a month into your investments. So what the red cells are the ones you fill in, and the black ones are calculated for you. So you put in a deposit here, $50, 12 times a year, and this is an average that it calculates for you. So if you put in things quarterly or annually or something, it's just going to round it to or average it across months. That's just an internal calculation that it needs to do. And where you start, what date are you going to start putting in $50 a month? So let's just say January of 2022. You're going to stop 14 years later in January of 2036. So this is your monthly savings. Now, you also get an annual bonus, again, hypothetically speaking. And so once a year, you're going to put in $500. Now that might be your whole annual bonus, that might be a fraction of your annual bonus, whatever you feel like you can commit to. And now you see here, if you divide 500 by 12, you're going to get an average monthly deposit of 42. I'll show you where that shows up, but basically just you can ignore that. And you're going to do this for the next 19 years. So let's jump over to the ledger. This is where you get to record just a little bit on a monthly basis and see your future and what it looks like. So let's just focus on the projection side for now. We'll look at some of these surrounding columns later. Notice the cash flow. So we said we were going to put in $50 a month, but it says 91. What's that all about? Well, remember, this considers compounding interest, and it compounds it monthly. So everything has to be averaged out to a monthly basis. So your $50 per month plus your $500 a year gets added together, and that's what this number is here. 50 plus 42, that's 92, right? So you see roughly $92 here. And the first month that you start saving for retirement or whatever you're saving for, you put in $91, and the balance of your account is worth $91, and you put in every bit of that. So you didn't get any free money or interest or returns on your investment, okay? The next month you put in approximately the same amount, $92. Now, remember, in reality, you're putting in $50, $50, $50, and then $550, $50, $50. So you squint at this is just the averages. But the point is, the next month you put in some money, and you start getting some free money. These are the returns on your investments. If you put in $91 the first month, you're going to get some returns on that, on average, bringing your balance up to $184. And you got a dollar of free money. So you're, the differences are too small to show right now, so let's move on. Let's go down here. So several months into it, you've put in $92, again, on average, and you get $8 in free money that month, because the balance from this month to this month, you see it went up $100, but you only put in 92. That means you got $8 in free money. That's the return on your investment. I find free money, it's not a technical term, but it's a fun, inspiring term. I want free money. Who doesn't want free money, right? So as you go down, now the cash, you'll notice that the numbers just gradually climb up. Why did it go from 91 to 92 and then 93, then 94? Like, what's that all about? Because we didn't say we were increasing our deposits. The reason is this spreadsheet takes inflation into account, and over time, in order to keep up the same amount of money going in current dollars of the day, you're going to have to put in $1 or $2 more per month as the years go on. So that's what that's about. The balance keeps going up. Your free money keeps going up. Now, the adjusted balance is taking inflation into account. So at this point, you'll have $10,000 if you looked at your investment portfolio, it would say you're worth $10,200. But that is 5.8 years into the future. And inflation will have taken away some of the buying power of that money. So in today's dollars, what you could buy with $9,200 today is what you'll be able to buy 5.8 years down the road with $10,000. And so inflation, if you're not accustomed to thinking about inflation, it can be a difficult concept to grasp. But basically, a dollar today is more powerful than a dollar a decade from now. So if a dollar would buy you a popsicle today, it might take $1.50 10 years from now to buy that same popsicle because the buying power decreases. So this is when you're thinking about, well, is this enough money for me to retire on or whatever it is, you probably should be looking at this column. This number might, will be bigger and be like, whoa, look at how much money I've saved. But when you're thinking about, yes, but how much is that really? You should probably be looking at this number. This number will always show it to you in today's dollars. So in fact, as time goes by, this number will always be today's dollars, like at that day. Whereas right now it's showing me what it'll look like in 0.9 years. Later on down the road, it's going to show you, this number gets smaller, this number, well, they all get smaller as time goes on because it's shifting to take inflation into account. That's more detail than I typically have to worry about, so if you didn't grasp that, don't worry about it. Let's keep going down. Now, this is about 14 years into it, and we've stopped saving for investing in investments. Now, there's a couple of reasons for that. One is over here in payments, we said we were going to stop putting $50 in a month every 14 years. But we said we were going to keep saving our annual bonus for 19 years. So what's up with that? So we'll come back to that, but just hold that thought for a minute. We're going to stop saving. But just at that point, do you see this column here? This is the percent increase per month of your balance that you paid. So if we go to the very, very top, you paid 100% of the growth for that month. It went up $91, you put in $91. Over here, it grew $98, but you only put in $92. So you only put in 94% of the growth. So as the amount of free money goes up relative to the amount that you're putting in, this percentage drops. So as we're getting closer and closer to the end, you're putting in less and less. So you're putting in $116 a month, and the free money that you get is 4 times that amount. So you're actually putting in only a fifth of what is coming out. This is great. This is what compounding interest is all about. As you put money in, the balance grows. The return rate hasn't changed, but the return rate is multiplied by your balance, and so the amount of free money you get from month to month just keeps growing. And at some point, it doesn't matter that you put in money anymore. So here's the theory. You're scrimping and saving because you understand compounding interest and the value of time and getting money in as soon as possible. So you're putting in as much money as you can afford, whatever that is. Now, eventually, after several years, the amount of free money that you get is so much larger than what you can scrimp and save for. And again, that doesn't matter. This is true. These proportions and this pattern holds true no matter how much you put in, okay? Whether it's $10 a month or $50 a month or $5,000 a month. So don't write yourself off if you don't feel like you can put in very much money. After several years, and here, right, not to sugarcoat it, this is 14 years out with the numbers we've put in so far. 14 years out, you're putting in so little compared to what's going in. Do you notice? Look at this. So because of free money growing, as well as what you're putting in, slightly growing, the monthly increase keeps getting bigger. Now, when you stop saving yourself, this number dropped. The next month, instead of, or rather the next year, because this is actually skipping years, which we'll talk about later, it dropped from $547 a month in growth to $488. But look what happens the very next year. Now it's even higher than it was. So by no longer saving here, within 2 years, you're right where you left off as far as how fast you're accumulating wealth. So the theory again is, if you've been scrimping and saving, at this point, it's time to take your foot off the gas. You can enjoy this $116 a month now. Go buy your Netflix subscription, restart some of those habits that you stopped in order to save more money for retirement. Because at this point, you're good. You can coast, because as long as you leave this money here, it's just going to grow. And if you kept saving money, as I'll show you later, it didn't make that much difference to your final end result. So here in this hypothetical situation, the default, you started when you were 20. And if we scroll down to this is the age column there, and this is how far from today it is. So actually, at time of recording this video, it's March. So you can see this is 0, 0. This is how long away is March? It's 0. And this is backwards in time, and this is forwards in time. So at any given time, we can look at a row and say, okay, this is when I'm 27, and this is 6.8 years away from me. So if I scroll down to, let's say, when I'm 59 and a half, this is when I would retire, 38 years away. Look at the balance, $864,000. That's incredible, and it's still growing. Okay. Now, also keep in mind the adjusted balance. This is almost 40 years away. So inflation has happened and compounded as well, bringing the buying power of your $864,000 down substantially. And with the inflation rate assumption that is programmed into the spreadsheet, that means that you're buying, having this much money in 40 years is sort of like having $450,000 today. So when you see this and you think, oh my goodness, I could buy, maybe you want to live in a place where houses are $864,000. In 40 years, you'll be able to buy half of that house. Okay, this is what the difference is there. But if we keep scrolling down, now you're 71 years old. Let's just look at the bottom here, because this has some interesting numbers. So when you're 72, you have $3.6 million, which is equivalent to $1.5 million in today's dollars. Look at how much you saved. You only saved $17,000, which was as easy as $50 a month plus $500 a year for bonus when you get your annual bonus. 3.6 million. Basically everything in your investment account was free money. It was paid you for the service you rendered of buying into various companies' assets that were growing. They were appreciating. And this is not a greed thing. This is not a, oh, look how it's centralizing. By lending essentially lending your $17,000 to other people, they were able to make it grow for you. You helped the market to grow by putting your money in. And if you're willing to put it in and leave it in for a long time, this is their thanks for your services rendered or your money lent. Okay, you become the lender and you collect that interest essentially. So this is the power of compounding interest. This is why I say everyone can be a millionaire. This is demonstration of a multi-millionaire based on just $50 a month. So you can go in here and put in your numbers for real and see what you can actually achieve. Now, I said if you leave the money in here. That's oversimplifying the problem, because you won't be the point isn't to leave your money in there and never spend it. When we look, you're going to need retirement money before you're 71. In fact, the spreadsheet is defaulting to assuming you'll want to start pulling money out at 59 and a half, which is the first legal age in the US for pulling money out of your tax-advantaged retirement accounts, like a 401k or an IRA. That's when you can start pulling money out without tax penalties. So if we look over here, do you notice this column, retired? As long as this is not 1, it's us making the assumption that nothing's being pulled out of your account. But when it says 1, which is what at 59 and a half, this is what you get to pull out. You can pull out $1,600 a month, and it will still grow. And in fact, because it's growing from month to month, you get to pull out more and more and more money. So by the time you're 71, you can pull out $5,000 a month. Remember how much money you put in to begin with? You can pull out in 3 months what took you 14 years to put in, and it was only $17,000, and now you're getting $5,000 a month in a paycheck, basically, in retirement because of what you've been saving. Now, let's go back and find out. I've talked about some assumptions the spreadsheet is making. You get to fiddle with those all you want. So let's go over to parameters. This is the return rate you anticipate, the annual percentage rate. So market, on average, long term, the stock market gets 10 to 12% return on investment, depending on the index that you're looking at. The NASDAQ does 12% over the long term. Some other indexes do 10 or less. So 12% is a very reasonable expectation for a somewhat, at least, diversified portfolio. It might be somewhat concentrated on stocks if you really do have 50 years to save, or even 30 or 20 years. You can be fairly concentrated on the higher volatility, higher growth stocks. We talked about diversification and strategy in the last class, so I won't cover it again here. But suffice to say, 12% is a very reasonable number to expect for people who still have several years before retirement. This is just a calculated, it's 12% divided by 12, so you get 1%, so you don't ever fiddle with that. It's just a formula here. So whenever you want to know, should I fiddle with that, look up here at the top, and if there's a formula instead of a number, like here's a number, so you can change that. Here's a formula, don't change that. The spreadsheet is calculating that for you. Inflation rate. What do you think the inflation rate will be? So you can talk to the experts, or you can research it yourself. 1.7% at one point seemed to be a reasonable average to base on. So that's what the spreadsheet is pre-programmed with. You're welcome to leave it here or to change it. The annual withdrawal rate is what percentage of your portfolio you can pull out per year and safely expect to not be eating away killing the golden goose. So we talked about in a prior class how the ideal nest egg is you don't want to save up for retirement enough to pay for 10 years of retirement, because what are you going to do if you live that 11th year, right? You want your nest egg to be perpetually supporting you, so that it doesn't matter how long you live, you'll have what you need to live. And so experts vary between saying 4% and 5%. The idea being, so let's just assume the ideal was the reality. If your returns are really 12% a year, this could be 12%. And basically your nest egg would stop growing when you start retirement, but it would never shrink either. You could live off of 12% every year, which would triple the number you see over here, right? This is actually 4% of this. Well, actually this, because this is anything that says adjusted takes inflation into account. So 4% of this is this. And as this grows up too. So that's where this number comes from. It's 4%. And if we could triple this number by changing this to 12%, but here's why we won't do that, okay? I mean, you're free to do whatever you want with this spreadsheet. But ideal is not reality. Averages are not reality. So even if you average a return rate of 12%, the problem is that sometimes the market will have a downturn year, or several years in a row, where you might lose 30% of the value in your investments. Well, if you lose 30% and you still sell 12% of it, then 12% of 70% of what you have left cuts you down to like 58%. And then if you do it again the following year, it's now 40-something%, and then smaller and smaller. And by the time the market recovers, you've got so little investment left, it can't grow, or it won't grow. It won't recover because you've been selling it when it was at a loss, a substantial loss. So that's why you don't sell as fast as, or you don't sell off your investments in retirement to match the return rate that's on average, because you need to make sure that even on the downturns, it's going to, like the Great Depression lasted about 7 years. So 7 times 4 is 28%. So if history were to repeat itself and have a terrible recession, where for 7 years the markets were down, you would have only sold 28% of your overall portfolio, which it leaves quite a bit of it left to recover. And if it's recovering at 12% or more, and actually after a recession it often recovers more quickly, then you're going to be okay. 5%, as I say, some experts think that that's okay too. I started with a conservative number. You can change it to 5% if you'd like. This next number, remember that sweet spot where it just, if you're scripting and saving and now you're putting in so little compared to how much it's growing for free, why don't you just enjoy your money and go buy your Netflix subscription or whatever. This is where you can change that sweet spot, okay? And while over the 20 years that I've used the spreadsheet, and it has served me very well, I started with 33% as the sweet spot, and I lowered it to 20 eventually myself, but you can play with it and see what happens. So we'll come back to that. Let's go ahead and play with this. First of all, let's make sure that this doesn't end. Let's change this to 1/1/2080. Do the same number here. Okay, so basically we'll, for the foreseeable future, we're just going to keep putting in money. And remember, the sweet spot's at 20%. So let's go back to the ledger. We still stopped paying money when it hit about 20%. And that's to be expected. Now let's look at the balance. We ended with $3.6 million. Remember that figure. Let's change this to 33%. Now it's 3 million instead of 3.6. So you lost $600,000 by stopping investments earlier. This was, I think what was this? Okay, let's go back to 20%. It was this $18,000 that you saved, and you got to stop saving for retirement in about 14 years. When we changed this to 33, we got to stop saving for retirement in only 9 years. So you shaved several years off of saving for retirement, which means you get to buy that Netflix subscription sooner. You saved $11,000 instead of $18,000, and you lost $600,000. $600,000! I mean, why wouldn't I want that? Well, maybe you do. That's a value or judgment call for you to make. Maybe $3 million is going to be plenty for you in retirement, and you'd rather live it up a little while you're still young, right? That's why it's a programmable value here. You can decide where that sweet spot is. But certainly if you say 0%, so that you just save for retirement all the way to the bitter end, in fact, even through retirement, which probably isn't very realistic, you're going to end up saving $88,000. Remember, it was $10,000 or $18,000. So now you've saved like 5 times as much money, but you only raised it from $3.6 million to $4.7 million. So yes, you added $1 million to it, and yes, that's a good trade, but you had to work and save 50 years for that instead of just 14. So because of the way compounding interest works, the money you put in at the beginning is worth much more at retirement than the money you put in towards the end. This money isn't worth much. It doesn't have much time to grow like the money that you put in 40 years earlier. That's why at some point it often just makes sense to stop putting money in, because the money you already put in is worth so much, and now it's time to enjoy life. Okay, that's the idea with that parameter. You can arbitrarily set a date to stop saving for retirement. So if you were to say 0 here, it's like, well, that doesn't make sense for me to save for retirement in retirement. So you could just set the date to January 2063 here, and it would just cut it off. So between these two numbers, either one of them could cut off your saving for retirement. The first one wins, and we'll cut it off. This is where you decide what age you're going to start living off your investments. So if you're thinking, well, I need more time to save, I shouldn't be pulling it out yet, or I don't want to quit working and I'm willing to keep saving for retirement or whatever, you can just change this to 65 or 72 or whatever age you want to start, and that will change where this happens. So if you were to change it to 65, for example, then these ones would go away, and this number would get a little bit bigger, basically. So that's 25, 21. So let's go back over here. 65. So now, actually, it didn't make, you can see the point. It didn't make any difference at all. It's still 25, 21. I mean, it probably did make, maybe in the cents column, I don't know. It made some difference. But the point is, I mean, you're getting, at this point, you're getting $17,000 a month in free money. So whether you pull out $2,500 a month of that or not doesn't actually move the needle that much. Again, especially since you only have a few years left of compounding interest, so it's not going to impact the bottom line that much. So if you want, I mean, this depends on when you start saving for retirement or whatever it is you're saving for, if you've got plenty of time, there's might not be much difference whether you retire at 59 or 65. You can go in and you can work if that's what you want to do, or you can retire and become philanthropic, do traveling, whatever it is you dig. So those are the projections. I find these incredibly inspiring because, so here's 3.6 million, okay? If we come over here and say, you know what, let's cancel that Netflix subscription for $15 a month. I don't need that. Let's see what $15 more per month would do. Remember, it was 3.6 million. Now we're at 4.2 million at 71 years old. Okay. When my wife and I sat down when we were 20 years old, or a little older, when I started my career, though, 22 years old, and I started this spreadsheet, this revealed to me the true cost of a Netflix subscription, okay? Or coffee, or the rug replacement that you want, whatever it is. You can see $15 a month for 14 years, right? Actually costs me $600,000. And look at the difference it made here. I mean, so the cash flow only went up $3,000. That's it. So did Netflix cost you $3,000 over 14 years? Or did Netflix cost you $600,000 over those 14 years? This is the most powerful part of the spreadsheet, because you can see for your, the decisions you have to make, how just a few dollars a month makes such an incredibly large impact on your bottom line. So people, please don't trust the Social Security system, which is, they themselves in their annual report say they're going to be insolvent in several years. They won't have the money to pay for your retirement. You can trivially, particularly if you start early, but even if you're later in life, this spreadsheet can apply to you and you can see what it means for you. But please, please take responsibility for your own retirement. And as you can see, if you do so, it is not hard to get a retirement that you can thoroughly enjoy, okay? You can be a multimillionaire, and if it's too late for you to be a multimillionaire, you can help your kids or your grandkids become multimillionaires easily. So let's talk about how to adapt this to you a little bit more. Let's start with payments more. It's unrealistic to believe that your ability to save is constant throughout your entire breadwinning career, okay? It's more likely that you'll get raises, promotions, you'll change your job, or kids will move out of the house and you'll have tuition to pay, which will take away some of your money, or you'll have, they'll move out of the house and they're paying for their own college, or they're out of college, and you'll have more ability to save. Whatever it is, things will change over time. This spreadsheet can grow with you. You never change, unless it's just wrong, an existing row, but you can adjust it a little bit. So let's say, well, you know what? I'm not going to pay $50 a month for potentially up to 58 years. I think in a couple years, I'm going to get a raise. So let's say in 2024, for 2 years, I'm going to put in $50 a month. And then I'm going to start putting in $75 a month starting in 2024 because I'm going to get a raise. And I think a few years down the line from there, I'm going to get another raise. And it's not that you're putting your entire raise into reinvestments, right? But you're putting some of it in so you can enjoy it some and you can save some. So let's say this is going to start in 2024. This needs to be 2024. That's bonus. I'm confusing myself here. So monthly savings, and then 2024, and we go from 50 to 75, and then in 2026, we're going to do something different. And we'll let that go perpetually for now. 1950 to 2050. And whenever you're adding rows that weren't there before, you need to copy down the formulas. Don't copy them by hand like writing the number 12. Like copy the formulas down so that they calculate the new thing. So it's important to make sure that these dates don't overlap if they're not intended to overlap. The annual bonus is supposed to overlap these dates because that's just general. But maybe you want to adjust this and say, well, when I get a raise, my annual bonus also goes up, and I'm willing to share some of that with my investments. You could do that. But now that we've put in this more realistic progression of, hey, over time I can save more and more, let's go back and look at the ledger. So we're still on average putting in $91, $92 a month at first. But if we look a couple years down the road, look at the jump here. Now it's 172. And later on, it jumps again into 231. And then it drops to 154, probably because something fell off. I'm not sure what. We'd have to study that. But basically, this is taking your own personal schedule into account, so making it much more yours. Now, you might not be 20 this year, right? Let's go in here. We can set your birth year. If you were born in 1990, you could put that there. And now, if you look at the ledger, it's actually showing that right now you're 32 years old. But let's say by the time you're watching this video, it's not January 22nd, and you want this to reflect you. All of these other cells are formulas, but this one is not. This is actually a value. So you can put in today's date on the 1st, I would suggest. So it's March 12th today, so I'm just going to put in March 1st, 2022. Boom. And now you see everything has shifted. Today, this 0 is now on this month. Going forward, it starts, April, May, going on. And this is your age, so now it's totally yours. Oh, and also, if you're coming in with investments already saved, good for you. Just change your starting investment here. So let's say you have $20,000 in your retirement so far already. So just change this to $20,000, and boom, look at that. That shows that you're already getting a lot of free money every month, and you're still putting in 92 because that's what you planned. And because you started with 20,000, remember, 18,000 is all you saved in 14 years, and you still ended up with like $3 million. Now that you start with 20,000, it's 12 million. But if you started with 20,000, odds are good you don't actually have, 51 years left. So you shouldn't always be looking at the bottom, to be clear. The bottom is interesting for the cash flow to see, oh, I only saved $11,000 more. That's amazing. But you really should be looking at the dates that are interesting to you, like 59 and a half, 65, whatever. When you're 65, you'll have $1.4 million saved. And $800,000 of that in today's money. Pretty good, right? So this is how you can customize this to be yours. Now, we've talked a lot about this and about this. We haven't talked anything about actuals. So let's talk about that for a bit. This is another calculated formula based on the inflation rate. So 100% will always be what you see today. But and so if we rewind this a bit and say let's say this you had started this last year, you'll notice today is way down here now, and that's today's dollars. And if you look back, then inflation looks like that. And if you look forward, then inflation looks like that. But we won't do that right now. Let's go back to this. Now, this is where you put these actuals here is where you put in what is real, as real happens. So starting this month, let's say this is your bonus month. So you actually put in $500. Now, actually, you should put in $550 like that. Because you committed to paying $50 from your paycheck every month and also paying $500 a year. So you should add that up and put in 500, but for now, for the sample, I put in 500. So you actually have $500 in assets the first month. The next month you put in 50, as agreed, and you notice that these are the two red columns, like these are the red numbers, so that's how you know which ones you put in. The next month your balance is $551, so you got $1 in free money. Next month, each month you put in $50 and your balance is basically increased. And notice they don't go up by $50 every time. Sometimes they go up, sometimes they go up less than $50 because markets go up and markets go down. So your free money in reality kind of jumps around a little bit. So the first you get 1, 2, 3, 4, 5 free dollars a month. The next month you actually lost $10. So you put in 50, but your balance only went up 40. Where did that $10 go? It went down because the market went down. And how does a spreadsheet know? Because you put in both how much you put in and what your balance is for the month, and it noticed, hey, it only went up $40 instead of the expected 50 or so. So now this percent increase paid, or this percent increase paid here, this is again just projected. The actual is that you put in 100% of the increase for that month, then 98%, 96, 94, 93, and then when money went down, you put in more than it went up, and so your percent increase paid actually is over 100%. And so it's going to jump around like that, and that's okay, that's normal, that's the market. Okay? This number here considers how much money you're going to save. And remember, well, right now, you're going to save, jump down here this way, you're going to save $28,000, the way we have it currently configured. The money you've put in so far being $1,000 exactly, you've put in 3.5% of everything you're ever going to save, according to the projection and the actual so far. So that's what that number tells you. So let's say it's now February. So the way I do this is I copy the row, paste it down here, and then I change the numbers and say, okay, well, yeah, $50 is still correct. Now the number's gone up to 1,100. Boom, away we go. And the projections, let's look at a balance, and I'll show you some more things here. So the red is the actuals. Now it went down to 0 because we don't have any data there. The blue is the projection. So the blue is a fairly regular curve. If you've got payments in here that suggest the amount you contribute goes up over time, then the steepness of this curve will go up. You'll notice a jump or something, a small jump, where those things happen. But you also notice it just generally goes up more over time because of compounding interest. And this only shows you 5 years in advance. As time moves on, you're going to want to slide the window, and this is where Excel fluency really helps, because you'll have to go in and actually change the data for this graph to look at a different window of the data in the ledger worksheet. But what you'll notice is that this line starts getting so very steep that you can't actually see anything meaningful anymore. So you have to change the scale to be a logarithmic scale. And that's the power of compounding interest, where the money goes up so sharply. But you actually have to change the scale because it just doesn't make sense to see proportional anymore, which is cool, or linear. But what I want you to notice, so the red, you see it kind of started above the blue and then it kind of aligned with the blue. Remember, the blue, the projection is basing an assumption that you're going to be paying that $500 bonus evenly throughout the year, but you didn't. In this ledger, the actual was you put in $500 at the very beginning, which put you basically ahead of the schedule. You had $500 where I thought you'd only have 92. So at first, you're doing better than it expected. Kind of really, that's within margin of error, basically, is what I'm saying. But as time goes on, the red will be above or below, depending on how well you keep your commitments, how the market is doing relative to what your projection was. And here we're projecting 12%. But this just kind of gives you an idea. And the blue is always showing what the overall projection was. It doesn't consider what the actual is. So if your actual is way down here, and it's saying, oh, you're going to be up here someday. Well, not if you're down here. So let's adjust that. Over in parameters, we can, right now, you see it's set to 0 here. 0 means that we should project balance based on an ideal. 1 would mean project balance based on most recent actual balance. So now if we change this to 1 and go back to balance, notice it's hugging the red until the red stops, and then it just goes off on its own. So as time goes on, if the red drops, the projection will always take reality into account before it starts projecting. So it'll give you a more realistic view. And that shows up in the ledger as well. You see here, it projected a balance of $92 for the first month, but the very next month after it saw what you actually did, it's like, oh, 500, great! And that's why you see the blue and the red align on the graph a lot more, because it's going to align to the red as far as it goes, and then it goes off and projects on its own. So this is actually a pretty good default if you're looking at what is really likely to happen. But once in a while, I'll switch this back to 0 and look at the balance just to see how I'm really doing compared to what I should be doing. Like if I pulled money out of my investments and that wasn't planned, then I'm not doing so well. And if I was counting on doing as well as projected, it's good to see what the original projection was so that I can say, oh, I've got a gap to fill. I've got to take on another job or save more aggressively or whatever it is I need to do to try to get that red back up to the blue, if I can, and if I care. Maybe I'm doing fine without it. Over here, these top lines, this is the projected % increase paid, so you look at the right axis here. So this is the first month you put in 100% of the growth. As you go down, in 5 years, we're going to only be putting in 60% of the overall growth, which is good. This purple line is the actual, so the green is projected. Purple is actual, and remember how we put in some periods where you lost $10 because the market went down? So those are the 125%, those are off the charts, and then down here it jumps down sometimes. So this is just another way for you to see how things are going. Things are going well as things go up, things are doing predictably well as things go down there. Here's another rendition of that. The blue represents what you put in from month to month. The red represents the free money. So as the first 5 years go by, you put in most of it. Now the free money makes up maybe a little more than half of what you're putting in. And as you slide the data for this chart over, or rather adjust the chart to look at a different window of data, you'll eventually see that this red overtakes the blue. Remember that sweet spot where it's 4 times larger? So the red will be enormous and the blue will be this little tiny thing, and you think, well, yeah, do I even need the blue anymore? No, you probably don't at that point. So you can stop saving for retirement because the red will take over. And that's such a wonderful, magical thing. Okay, and I'll leave this here. That's there for calculations in the spreadsheet. Something else to point out, I mentioned that it was going by years down here. You can see that every row is a new year, 17 years away, 18 years away. Up here, it's per month. Well, how does that work? Well, Excel has hidden rows, and you can kind of see the difference. This is just a single faint line between each row, but down here, it's a double line. That suggests that there's hidden rows there. So the hidden rows are all the months between the month you started with. We started in March, and so all of these are March months of each year. But if you want to drill into a particular year, you just select across these 2 rows and say unhide. Let me get that on screen so you can see it. Unhide here, boom. And now you can see all the months of that year. And if you ever want to go back, you can just select everything between the 2 March months and say hide again. And there you go. All right. Now, you can have as many rows here as you want. And as time goes by and you realize, hey, you know what, I didn't get that promotion the date I thought I would, I got it later, or I got it sooner, or I got more promotions, you can just keep adding rows and going back and adjusting the stop dates so that you can put in things to replace those projections. And there's plenty of rows for you to add your personal stuff. And here at the bottom, don't put things below it. But if you need more rows, you can just select a bunch of rows up here in the middle and say insert, and now you've got more rows to work with. It just grows with you, okay? Now there's a couple of other neat things about this payments worksheet. One, you could add one-time events to it. Let's say, and you could only do this if some of your investments are in your brokerage account, okay? You don't want to do this if all of your money is in your tax-advantaged account. So as part of your diversification strategy, also think about saving some of, you should, again, we've talked about this before, max out what your employer will match if they match 401k contributions. Do everything you can. But if you have additional money that you can save beyond what the tax-advantaged accounts will allow for, or if these projections that you see in the spreadsheet suggest you're going to be fine. Like, you've got more than enough money for retirement. In fact, you could start pulling out money way before 59.5 and be just fine. And basically, you could be one of those people who retire early. That's great, but you should only do that if you've got money to pull out from a non-tax advantaged account, because if you pull out money from your 401k before you're 59.5, guess what? You pay fees, penalties, extra taxes, et cetera, et cetera. So, but let's say you did have some of your investments in a regular brokerage account such that you were free to withdraw, and you wanted to go buy a minivan for $20,000 at some point in the future when you could afford it. So let's see. Here you could technically pull out 20,000 because you've got 51,000 there. Again, assuming that your brokerage has at least the 20,000 that you need. So that's March of 2035. So March of 2035, you're going to buy a minivan. Now, because all the calculations in the spreadsheet are based on months, you can't just put a single date here for a single event like buying a minivan. You have to give it the full span of the month for this to work. So we're going to say 3/31/2035. Now, we're going to put in a negative number because you're going to withdraw $20,000 for that minivan here. It's going to happen once per year. Now, this is going to want to say, okay, that's only $1,600 a month. Well, yeah, but we're only giving it a month time span in which to execute, so that's not good enough. So in this case, we're actually going to also override the monthly deposit and say, just take this exact number. So now it's $20,000 for this month to buy a minivan. So let's go look at this month and see what happened. There it is. Now this is actually more than 20,000 because remember it's taking it into account inflation, and because it thinks it knows that this isn't today. So typically you would do this on the day of, like it would be, or the month of, or something like the year of, something closer to the actual date. You wouldn't plan on buying a minivan 13 years in advance. So this inflation percentage would show 100% instead of 124%. At which point this would actually show $20,000 projected because you're talking with today's dollars. But since we're talking about $20,000 in today's dollars, but 14 years down the road, it's like, well, if you want to buy a $20,000 car in 14 years, you're actually going to have to spend $24,000. Isn't it amazing how that works it out? But again, it's not normally going to be a problem because you're going to put in your minivan purchase the year of. But do you see what happens? Your projected balance now drops from 43 to 26,000. And you can see that's going to set you back 4 years. It's 4 years before your balance gets back to where it was. So minivan, setting you back on retirement savings by 4 years, is that worth it? Well, let's also look at, by the time you do retire, at say 59 and a half, you have $220,000 in your account versus without the van, you had $336,000. So that $20,000 van is actually a $116,000 van. So do you really need that minivan? Or could you buy a used car, something? Like this lets you really see the impact of individual decisions, which is great. But, in full disclosure and the power of the tool, I have a few rows like this. Not $20,000 necessarily, but I have a few large expenses that I took out of my brokerage account, and I was able to reflect and let me see what the impact would be. And you can come over here and see, that's out of the window, but you'd see the blue line drop as well. Because it's just a reflection of what's in the ledger. So that's point number one about the payments, is you can actually put in one-time events, which is cool. So the second thing you can do that's powerful in the payments thing is make a regular withdrawal from your brokerage account and reflect that. Now, if you're saving every month, what does that mean? Why would you save and also withdraw? Well, maybe the saving is via your 401k and you never see that money. Or your IRA, whatever it is, stock awards, whatever it is, because you can put that in there too. If you get stock awards or some sort of a stock bonus that goes into your investments directly, you can and probably should record it here. But then if you're going to start siphoning off some of that money, you should record that as well. So let's say this is going straight into my 401k, but I need $25 out of my brokerage account every month. So I can say I want $25 out, and I'm not going to copy this formula because I messed that up for the van. So let's copy these numbers from the regular row. And I'm going to do this I'm going to do this right away. So 1/1/20, let's say starting in May. May 1, 2022. And I'm going to do it for the next year. I need 25 extra bucks. Extra spending money. Now if I come over here, you see the number dropped starting in May. Instead of a cash flow of $92, it drops to $67 because $25 is coming out. So this full money is going in, but it recognizes that I'm also pulling money out. And so what this shows is the net cash flow. And when I come over here to this isn't just paycheck. It's not just what I put in. It's the net cash flow to my investments. And so what I should actually be doing now is, since I'm putting in 50 through my 401k, but I'm also withdrawing 25, the net that's going in is only 25. And I would have to go and change the, as time goes on, I would only be putting 25 in. Now that might be complicated to calculate by hand depending on your situation. I actually created a couple of custom reports in Quicken that will tell me on a monthly basis how much the net went into a particular set of accounts. So I've got a 401k, I have an IRA, I have a brokerage account. I basically selected those accounts and then asked Quicken to give me a report of the flows into and out of those accounts and a subtotal by month. So I can see, okay, this, and fill these in from month to month, what the net cash flow is. And then same thing for those same accounts. I also get a report on by month what their balances are, so I can go in and fill these numbers. So actually maintaining the spreadsheet is very easy. And if I did start pulling out $25 a month, that would automatically be reflected in the report. And so I would automatically be putting them in here. So that's the spreadsheet. I hope it makes an incredible difference in your life. Like I said, you'll have to pick up some Excel skills if you're not fluent in Excel. Hiding rows, copying formulas, tweaking some things sometimes. This spreadsheet has grown along with me for the last 20 years. I can say this spreadsheet has been extremely reliable. When I look at the balance graph with ideal set and I see how it predicted the last 20 years of my life and what the actuals for that life were, it's freakishly accurate. Now, some things are unexpected. Like I withdrew some brokerage money to make a down payment on a house and to buy a car, things like that. So the red would drop. But then I would just set a goal to save more or whatever I need to do to try to get that red line back up to the blue. And it was possible each time. And so I was able to keep it fairly accurate. But even if you can't get it back up there, again, that's what the 1 is for. But the point is, between inflation and compounding interest and return rates and things, this is a very powerful tool to get a very real idea of what's going to happen. And I strongly suggest you start filling it out and you maintain it every month. And review your budget if you have one. And if you don't, think about starting one. But review where your money is going and ask yourself, what could we save $15 more a month? And keep asking that question until you really are comfortable with the balance between the numbers when you're going to retire and your lifestyle now. Make an informed decision. That's what this is all about. Remember, a few $1,000s of Netflix over 14 years actually might make $600,000 difference in your retirement. And even if you don't need that $600,000, that $600,000 you could have given to a charity, potentially, or you willed it to your kids, or whatever it is. Like, think hard about the trade-offs that you make. So that's why I like this spreadsheet so much. So keep it around. And some years down the road, if you feel like you're well off because of this class or because of this spreadsheet motivating you, then think of me and maybe send me some thanks in some monetary fashion. Here's a few different ways you can do that if you'd like. It's not required, of course. And feel free to share the spreadsheet around. Don't share your spreadsheet around, but remember that template file that doesn't have your data in it. You double click it and it gives you this starter one that you have to give a name to. Share the template around with other people, because more than anything, I just want people to be aware of what they can do. Okay, like I said, everybody can be a billionaire, whether it's as long as they start early enough. $50 a month, even if that feels like, but I don't have $50 a month to save. Well, maybe you do if you could cut down costs. But even without $50 a month, remember $50 a month gave you like $2-something million, $25 a month would also be great. Like, to put in your numbers before you give up on yourself. And if you only have a few years left for retirement, again, maybe you don't need this many rows, but it still applies to you because you can look at that 3 years in the future and see what you're going to get. Now, one other piece of advice, 12% is a good number to put in there by default because that's what the market on average does. But I have a couple of other things to show you. My market returns over the long term is actually substantially more than 12%. So I could come in here and put in 16% or something and see just how wildly that changes the numbers. 27 million, what was that on before? My goodness. Like, let's go back here, 12%, 3 million, $27 million. Again, that's the power of compounding interest in the interest rate. But I get this or more on average for my career. So I could put 16% or maybe even a little bit more, but then I'm kind of betting my retirement plans on my ability to continue outperforming the market, which might not be a safe bet. So leaving it at 12% is probably a good idea. If you can do better than that, then great, bonus for your retirement, right? I want to mention too, and contrast this spreadsheet with some of the tools that you can use. We talked in a previous class about RamseySolutions.com. If you click on the RIQ feature, they'll tell you how you're doing toward retirement and how much, whether you're on track, how much you need to save, etc. In that case, what I tried is I put in the same numbers into that as I put into the spreadsheet that we've been showing you, just to see if the numbers line, and they aligned perfectly. But the spreadsheet allows you to store so many more details and life events and plans and projections, which is why I prefer it. Another tool that I've compared this with is what Fidelity offers they've got a retirement planning area of the website where they can actually look at your actual portfolio and when you want to retire. And they'll say you're on track, or hey, you're doing really well, or you're not doing so well, you need to fix some things. And interestingly enough, the spreadsheet tells me I'm doing really, really well. Fidelity, at least one time that I ran the tool, said you need to fix some things. There's some problems here. You're not saving enough, or your diversification's not good, etc. Which it was interesting to contrast that. Now, Fidelity goes through, whereas the spreadsheet just does like the 12% average assumption. Fidelity goes through millions of actual historical or theoretically plausible scenarios and plays your investments through it. So, for example, what if another recession hit just before I hit retirement age? Maybe I wouldn't do so well. And so they'll say, hey, you're not doing so well. Now what they do is they look at my portfolio and they see I'm awfully stock heavy. Now I've talked about not investing in individual stocks so much, but my mutual funds are stock heavy. So my diversification is on a high risk end. So yeah, when Fidelity plays it out, they're going to see that I'm in a high risk area, that a lot of these scenarios end up with me running out of money during retirement. But what they're not taking into account is that my strategy will change as I approach retirement. Right now, I'm in a long-term strategy where the diversification is a high-risk diversification, where it's heavy on stocks, because for that high risk, I'm also getting high returns. And again, we've talked about risk in the past. The risk isn't that I'm going to lose everything. The risk is just that it's volatile and it won't be there when I need it. So as I approach retirement, I'm planning on changing my diversification from high risk to lower risk, and probably just for a portion of my retirement, because when I retire, yes, the first 10 years of my retirement will be close, but the 10 years after that will be far away. So I'm going to divide my portfolio logically and keep some of it in long-term strategy and some of it in short-term strategy, which will handle the risk that Fidelity is saying, hey, I'm in trouble. I'm not going to have enough money. So different tools will give you different results, and it's important that you understand and maybe talk to a financial advisor professional who can take those things into consideration and give you more personal advice. So another option, I mentioned that I keep track of my money in in Quicken, and then I record some things in Excel, yes, but Quicken is my main financial software that I use. Another option for you, if you don't have Quicken or you don't like to use it, is Money in Excel. This is a template that has a lot of smarts built into it. So you could do budgeting, you could record individual transactions. It will even download your transactions from most banks into Excel. This is a premium feature, so you actually have to you have to be an Office 365 subscriber, which is about $100 a month, in order to get access to this spreadsheet. I tried it. I personally don't use it. It doesn't work for some of my banks, and besides, I'm already in Quicken. It also doesn't have the same kind of reports and customizations that Quicken has. So it's not for me. It might be for you. You could try it. So thanks for watching. This, as I mentioned, is the 7th in a series of Investing 101 classes. There will be at least 9. Next time we're covering stock options, and the time after that we're talking about cryptocurrency. So some exciting topics coming up. Be sure to check the playlist for past and future videos in this series. Subscribe, possibly hit the little gold bell notification button to make sure that you get notifications when the new videos come out if this interests you. Check the description of the video for the links to download this spreadsheet, and I'll also include a link to the Money in Excel template as well, which again will work for you if you're an Office 365 subscriber. I look forward to seeing you again. If you like this video, find it useful, do hit like. It helps YouTube bring this to other people, it helps more people out. So it's a way to pay it forward. And please feel free to share this with your friends and family. We'll see you next week.